AT&T is up almost 7% this morning. They just reported they killed it. They're still down 13% year to date. Mo, what was their reported EPS and revenue?
So earnings came in at 64 cents versus 62-cent estimate, and $30.35 billion in revenue versus $30.20 billion in revenue.
Okay, so they beat a little bit, enough to matter for them because AT&T's been beaten up a lot lately. They did the spinoff last year of some of their assets. So let's go take a look at AT&T as a company overall. So 6.58%, it's up 15.26. Here is the appealing part to a lot of people out there, a dividend yield of 7.4%. Now, in the last year, they did free cash flow of $18.2 billion, and their dividends ate up $8 billion of that. That's a big chunk of the money, but not enough for me to care about it. But I will say this. This is my biggest concern about AT&T. Their market cap's $110 billion. That's if you bought every share outstanding on the market. Mo, look at this enterprise value.
That's a big difference.
$390 billion. Guys, this difference right here is debt. That's almost $300 billion in debt.
That's a big one.
Big one. I think this is what's stifling AT&T, especially that we're now in an upward rate environment. The issue you have is when rates are low, you're like, okay, cool, take on the debt. It's not a big deal. You'll pay 4%, blah, blah, blah. But we've had rates skyrocket in the last year and a half, 2 years. Eventually, this debt will need to be refinanced. And when it's refinanced, what's going to happen to their interest cost? It's going to skyrocket. It's absolutely going to skyrocket. But I know AT&T will do their best to keep this dividend high. Why? Because it's about the only thing keeping investors in the company.
Literally the only thing.
Yeah, and there's a lot of dividend people out there. You know, I'm on Twitter and I'm very active there, and I just see dividend people talking all the time about dividend, dividend, dividend. I get it. But you got to remember, can the company afford the dividend? And is there a better use of the cash than paying a dividend? I personally believe, and I think Mo would agree with me, that the dividend should be the last thing the company does with its free cash flow.
Correct, especially in this situation.
Yes, there are 5 things a company can do with free cash flow. Pay a dividend, pay down debt, buy back shares, invest in themselves, and make acquisitions. AT&T has shown that they do not make acquisitions very well.
Very poor at it.
Okay, so let's eliminate that. But when you look at this, the price to free cash flow, and there is no PE right now because they have a negative net income. And by the way, I want to make note, negative net income, but positive free cash flow. So this is probably just a write-off. But when I look at this number of this 5-year PE, guys, unpopular opinion here, cancel this dividend and start buying back paying down debt and buying back your shares. That's what you need to focus on if you're AT&T. Make the company stable. Debt works the same way for companies as it does for people. If they hit some bad times, what's going to happen when if these covenants for the debt come through and all of a sudden bankers are saying, hey, you owe us the money now?
Bad.
It would be very bad. Yeah. If all of a sudden these interest rates start to increase. So Mo, why don't you break down some of their their actual press release on their current earnings?
So they actually did have some strong third quarter results here. Revenue of $30.4 billion, up 1% year over year. Cash from operations.
1% year over year. This is not a growth company.
That's pretty good, actually.
It's better than declining.
Correct.
Okay, go ahead.
Cash from operations activities of $10.3 billion, up $200 million or 2.4% year over year.
Yippee!
Free cash flow of $5.2 billion, up $1.3 billion year over year.
That's a big jump.
It is a big jump.
Yeah.
They expect full year free cash flow to be about $16.5 billion versus previously guiding for $16 billion.
Okay, so it's lower than what they did in the last 12 months. Okay, keep going.
Now let's get into some of their things that they did. They delivered 468,000 postpaid plans, meaning somebody went out and got a cell phone plan.
Yeah.
Versus prepaid is like your burner phones.
Yeah.
Mobility services revenue up 3.7%. Almost 300,000 AT&T fiber net adds.
By the way, I used to have AT&T fiber. It's good.
I've heard it's good.
Yeah, it's good.
They surpassed 8 million fiber subscribers, doubled their customer base in less than 4 years. That's really good. There was one more thing I wanted to show here, and it was debt related. Total debt was $138 billion at the end of the quarter. Net debt was $128.7 billion. So, and then there's their free cash flow for the quarter of $5.2 billion.
Okay.
But those are their main highlights.
So, look at this 5-year return on invested capital. AT&T, I have a recommendation.
Stop trying to do things.
Pay down your debt. This says you get a terrible return on the money invested in the business.
You're not good at what you do. Just pay down your debt. Buy back your shares.
Buy back your shares. Stop that dividend.
That's something that you can do, and nothing bad will happen.
I really think the company will be better if they do that.
100%.
The company will absolutely be a better company if they do that. Now, one thing I'm going to look at, Mo, let's go to their balance sheet. Quarterly balance sheet. Total debt, $290 billion here. Total long-term liabilities of $236. Man, that's a lot. But let's say they're able to repeat $16 billion. In 13, 14 years, 15 years, they're out of debt. And that sounds like a long time. It is a long time, but maybe they split it up. Half and buy back shares with the other half. Mm-hmm. This dividend, guys, I just think it's a bad idea.
I know what they're worried about. Stock price would crash. Stock price might go to $7, but
guess what? Buy back more shares.
Buy back more shares and think of that as a good long-term play.
See, the thing is, this is where we talk about having companies compensate their executive team in a way that's also in line with investors. The problem is they'll sit there and say, and I don't know what the executive team, how they're compensated here, but they'll attach it to a stock price. Attaching it to a stock price is fine, but that's like just saying, like to me, you sit there and say, what's going to lead to the stock price going up? Well, things that will lead to stock price going up are paying down debt, buying back cheap shares. Mm-hmm. That's going to lead to the stock price going up. Incentivize that. They're clearly doing a terrible job of investing the money in the business. 4.6% return on invested capital means, guys, when they're investing money in the business, this is the return they're getting. If you're an investor in the company, are you happy with that?
It's terrible.
It's absolutely awful. You know, AT&T to me is a company that has a great brand name. Everybody knows it.
Yes.
They've got, what's her face? What's the very beautiful...
Oh, the spokeswoman?
Yeah, spokeswoman. I
don't know.
Very voluptuous.
Endowed?
Lily, thank you. Lily. I mean, I look at this thinking to myself, and they had LeBron in a commercial recently. I just look at it going, this dividend just perplexes me. It's so funny. Literally, if they cancel that dividend tomorrow, the stock would plummet. And guys like you and me would be like, good for you guys. They said, hey, guys, we're going to start buying, but we're going to start paying down debt and buying back cheap shares.
Because then I would see a path forward for them for the next 15 years.
Yeah.
Like a legit path forward, not these Hail Marys into DirecTV and all this crap to try to look sexy.
Yeah, it's tough. It is really tough, Mel. Okay, let's look at the 8 pillars. Let's see how ugly this is. Ooh. Is this not the complete opposite?
It's the opposite.
Guys, if you haven't watched our videos before, our joke is that we love companies that have all these green and these two red, because all we're doing is trying to wait for the price to fall. Here, it's exact opposite. We actually want these to become green. It's unbelievable, isn't that, Mo?
Yeah, this is insane.
Wow. Now, this cash flow is a little misleading because it's based on the financials back in the day when they had more companies beside it. So I think it's a little misleading there. This is the big one to me. This is what really bothers me. That's what really, really bothers me. Ugh. I just can't.
And not only that the ROIC is bad, that there's no end in sight. It's not like they're saying, we're going to go buy back shares. We're going to cut our dividend. We know we're bad at this. We're going to start a new plan forward. I could see that going lower.
What do you think analyst estimates are for the EPS of this company for the next 3 or 4 years? What kind of growth?
2% on the high side.
Look at this, Mo. They're expected to make $247 a share this year and $267 in 4 years.
Wow.
Guys, when a company is slow growing, they've got to get return to investors some way. I don't know if I've mentioned this yet, but they got to pay down debt and they got to buy back shares. That's how you're going to drive the value for investors.
I haven't looked at the revenue yet. What do you think it is? What do you think the growth is?
Well, I see the graph.
Oh, you see it? Okay, I don't see it.
I mean, it's low single digits.
Say 2%.
It's like 1%, 2% at the high side.
Yeah. Oh boy.
So let's do stock analyzer. And I'm going to assure you that it's probably going to be a lot of green. So guys, before we get into stock analyzer, you guys have heard me talk about our software and our community. Most importantly, our community of 1,000 investors. Now, I would like you to try it out. Now, I'm not asking you to make a yes or no decision today. What I'm asking you to do is to make an informed decision. And the only way to make an informed decision is get on the inside. That's it. You're not going to do it from the outside. Just like when you want to buy a car, you got to take that test drive, take it for 15 minutes. The difference here is we want to give you a 7-day full access free test drive all of our community, all the tools. You can go in there and have that conversation with people about AT&T. It's a no-brainer, 7-day, full free access test drive. Go to everythingmoney.com. Go try it out. I guarantee you'll walk away saying, this changed the way in which I look at money and investing. It's going to change your life. It changed ours. And this software was created because people kept asking me I had this Excel sheet that did all these calculations, and they said, we want the Excel sheet. So we created the software for that reason. So go check it out. Now, Mo, I'm going to pull up my history on AT&T.
Yeah, I pulled up a previous one.
I did it in September 11th, 2023. You know what I'm going to say to that?
Yeah, I was going to say you're going to want to ask me the date I did it, but you did it the same day.
Never forget.
Right.
And I was going to say, the first thing I was going to say was -2, 0, and 2 for revenue growth.
I did -1.5, 0, and 1.5.
Okay, basically in line. Profit margin.
3.5, 5.5, 7.5.
I did 5, 7, 9.
Okay.
Free cash flow margin?
11.5, 13.5, 15.5.
So I'm wondering if I was too conservative here, Mo. I did 8, 10, and 12.
Why don't you keep it, and mine kind of gives them the benefit of the doubt, and we'll see the comparison.
But here's the deal. I look at how I beat it up over here, but I think my PE is too low, too high. So look at PE and price of free cash flow. This is potentially a declining business. Is 9, 12, I mean, is this reasonable? No, I think I'm going to go a little bit lower.
I did 10, 12, and 14%.
I'm going to do 8, 10, and 12.
Okay.
But here's the deal. I'm going to go back on free cash flow, and I'm going to change it to 9, 11, and 13.
All right.
What about desired return? Now, here's a desired return. This is the hard part, guys. This is your margin of safety. This is where you sit there and look at it and go, okay, there's a lot of scary things involved in this company. The more margin of safety you want, the higher return you need. So the higher assumptions you make, the higher returns you need. Mo, I did 14, 17, and 20.
I did 13, 15, and 17.
Let's do this first. I'm going to do 10% first.
Okay, I'll do this.
Now, guys, you need to stay with me here because I'm going to do two different numbers. This 10% number is saying, listen, if you want to match the market and these assumptions happen, here's what you need to pay. So I'm going to hit the analyze button. A low price of 660, a high price of 26, and somewhere in the middle about where we're at right now. This is with no margin of safety.
Right.
I'm going to go in there and put my margin of safety in there, 14, 17, and 20. Analyze button. I have a low price of 5 to 10, high price of 10 to 15, and middle price of 7 to 12. Mo, what do you got?
I have 4 to 14 on the low, 9 to 19 on the high, 7 to 16 in the middle.
Now, here's what I want you to hear. This is the very important point I want you to hear. If these were all green, I'd probably still personally be avoiding AT&T because it tells me their management team isn't allocating the capital the proper way. Yeah, and that's a good value destroyer.
For me, it's not even on my watch list. It'll be on my watch list when it's headline news that they cut their dividend to 0.
To pay down debt and buy back shares.
Yep.
Guys, everythingmoney.com, 7 days free trial. Just go sign up today.